Good morning, everyone. I hope that you have a good night's sleep and you already take your breakfast. For today, we are to report the International Financial Institution and Global Corporation to be reported by yours truly, Charlene Conanan and Diana Rose Morales. So let us first tackle the International Financial Institution. So, the international financial institutions were founded by groups of countries to promote public and private investment to foster economic and social development in developing and transitioning countries. International financial institutions, or IFIs, play a major role in the social and economic development programs of nations with developing or transitioning countries. The first international financial institution, also known as the Multilateral Development Banks or MDBs, were established after World War II to help rebuild war-torn countries and manage the global financial system. Later, regional development banks were founded to promote economic growth and cooperation. IFIs are owned and managed by national governments, acting as borrowers, lenders, or donors. Now that we know on what is international financial institution, let us tackle on how does it work. IFIs provide long-term, low-interest loans, credits, and grants to finance projects run by governments or the private sector. They operate through shareholdings, trade and services, and bank shares, and provide technical and policy advices to governments, private enterprises, and civil society. Now, let us tackle on what are the different types of IFIs. So the first type is the central banks. It is a financial institution responsible for the oversight and management of all other banks. In the United States, the central bank is the Federal Reserve Bank, which is responsible for conducting monetary policy and supervision and regulation of financial institutions. The second one is the retail and commercial banks. Traditionally, retail banks offered products to individual consumers while commercial banks worked directly with businesses. Currently, the majority of large banks offer deposit accounts, lending, and limited financial advice to both demographics. The third one is the internet banks. A newer entrant, the financial institution market are the internet banks, which work similarly to retail banks. Internet banks offer the same product and services as conventional banks, but they do so through online platforms instead of brick and mortar locations. Fourth is the credit unions. Serve as a specific demographic per their field of membership, such as teachers or member of military, while products offered resemble retail banks' offerings. Credit unions are owned by their members and operate for their benefit. Fifth is the Savings and Loan Association. Financial institutions that are mutually held and provide no more than 20% of total lending to businesses fall under the category of savings and loan associations. Individual consumers use savings and loans associations for deposit accounts, personal loans, and mortgage lending. Sixth is investment banks and companies. Investment banks do not take deposits. Instead, they help individuals, businesses, and governments raise capital through issuance of securities. Investment companies, more commonly known as mutual fund companies, pull funds from individuals and institutional investors to provide them access to the broader securities market. Seventh is the brokerage firms. Brokerage firms assist individuals and institutions in buying and selling securities among available investors. Customers of brokerage firms can place trades of stocks, bonds, mutual funds, exchange traded funds, and some alternative investment. 8 is insurance companies. Financial institutions that help individuals transfer risk of loss are known as insurance companies. Individuals and businesses use insurance companies to protect against the financial loss due to death, disability, accidents, property damage, and other misfortunes. And the last one is the mortgage companies. Financial institutions that originate or fund mortgage companies, loans are mortgage companies. While mortgage companies serve the individual customers or consumers market, some specialize in lending options for commercial real estate only. So let me show an examples of IFIs. So these are World Bank Group, European Bank, Asian Infrastructure Investment Bank, Asian Development Bank, Inter-American Development Bank, African Development Fund, and Green Climate Fund. These are only some of the examples of an international financial institutions so that we know what are the types on what is international financial institution and how does it work. Let us tackle on what are the advantages and disadvantages of it.
So let's take a look in advantages and disadvantages of financial institutions. The advantages of raising funds through financial institutions are as follows. Here, finance is accessible even during periods of depression, when no other foundation of finance is accessible in the market. New companies which may find it hard to elevate finance from the public can get it from these institutions, as these institutions carry out a systematic investigation before conceding support to an apprehension. Relationship with them helps to increase the credit worthiness of a company. Besides providing funds, many of these institutions endow with financial, administrative, and industrial guidance and consultancy to business firms. Assistance is obtainable when recourse to usual sources is impossible or unbeneficial. Financial institutions provide long-term finance, which is not provided by commercial banks. The rate of interest and repayment measures is convenient and economical. Facilities for repayment in simple installments are made obtainable to the deserving concerns. For long-term business funds requirements, financial institutions are preferable as they provide long-term finance, which is not provided by commercial banks. Modernization and development plans can be financed without much strain on the financial organization of the company. Besides providing funds, many of these institutions provide financial, managerial, and technical advice and consultancy to business firms. Obtaining a loan from financial institutions increases the goodwill of the borrowing company in the capital market. Consequently, such a company can raise funds easily from other sources as well. As repayment of loan can be made in easy installments, it does not prove to be much of a burden on the business. Loans and guarantees in foreign currency and deferred payment facilities are obtainable for the import of required technology and equipment. Along with finance, a company can obtain specialist guidance and direction for the successful planning and management of projects. The funds are made available even during periods of depression when other sources of finance are not available. In disadvantages, the major disadvantages of raising funds from financial institutions are as given below. Restriction on dividend payment imposed on the powers of the borrowing company by the financial institutions. The concern requiring finance from public financial institutions has to submit itself to a thorough investigation that involves a number of formalities and documents. As these institutions come under government criteria, they follow rigid rules for granting loans. Too many formalities make the procedure time-consuming. Many deserving concerns may fail to get assistance for want of security and other conditions laid down by these institutions. Financial institutions may have their nominees on the board of directors of the borrowing company, thereby restricting the powers of the company. Sometimes, these institutions place restriction on the autonomy of management. They lay down a convertibility clause in loan agreements. In some cases, they insist on the appointment of their nominees to the board of directors of the borrowing company. Financial institutions follow rigid criteria for grant of loans. Too many formalities make the procedure time-consuming and expensive. Certain restrictions, such as restriction on dividend payment, are imposed on the powers of the borrowing company by the financial institutions. Financial institutions may have their nominees on the board of directors of the borrowing company, thereby restricting the powers of the company. Many deserving concerns may fail to get assistance for want of security and other conditions laid down by these institutions.
Good morning, everyone. We are assigned to tackle the topic International Financial Institution, and in my part, I was obligated to discuss the global corporation, opportunities, and the challenges of international financial institution. Global corporation, a global company, is generally referred to as a multinational corporation or MNC. An MNC is a company that operates in two or more countries, leveraging the global environment to approach various markets and attaining revenue generation. These international operations are pursued as a result of the strategic potential provided by technological developments, making new markets a more convenient and profitable pursuit, both in sourcing and pursuing growth. Opportunities. As gross domestic product (GDP) growth migrates from mature economies such as the US and EU member states to a developing economies such as China and India, it becomes highly relevant to capture growth in higher growth markets. It is a particularly strong visual representation of the advantage a global corporation stands to capture where the highest GDP growth potential resides. High growth in the external environment is a strong opportunity for most incumbents in the market. The map shown is the highlight, where the strongest growth opportunities currently are as of 2010. In that year, China and India had the highest GDP growth rates. Challenges. First, public relations. Public image and branding are critical components of most business. Building this public relations potential in a new geographic region is an enormous challenge both in effectively localizing the message and in the capital expenditures necessary to create momentum. Second is the ethics, arguably the most substantial of the challenges faced by MNC. Ethics have historically played a dramatic role in the success or failure of global players. For example, Nike had its brand image hugely damaged through utilizing sweatshops and low-wage workers in developing countries. Maintaining the highest ethical standards while operating in developing countries is an important consideration for all MNC. Third is the organizational structures. Another significant hurdle is the ability to efficiently and effectively incorporate new regions within the value chain and corporate structure. International expansion requires enormous capital investment in many cases, along with the development of a specific strategic business unit or SBU in order to manage these accounts and operations. Finding a way to capture value despite This fixed organizational investment is an important initiative for global corporations. The last one is the leadership. The final factor worth noting is attaining effective leaders with the appropriate knowledge base to approach a given geographic market. There are differences in strategies and approaches in every geographic location worldwide, and attracting talented managers with high intercultural competence is a critical step in developing an efficient global strategy.